Assalamu alaikum guys. So this is, as I promised, I'm going to make a video on business and technology, management accounting and financial accounting, and this video we are going to go through the financial accounting paper. This is uh, the third paper which I'm doing. I have previously done business and technology and management accounting. Go and do check those out videos if you haven't. Okay, this video will be on financial accounting part 1, where I will only be discussing the section A questions, section B questions, and other questions, extra questions will be in part 2 and 3. Okay, so let's start with the exam. As you can see, section A has 35 questions and B has 2 questions worth 30 marks and worth 70 marks each. And the pass rate for all the ECCA paper is 70%. Okay, so let us start. Which of the following calculates a sole trader's net profit for a period? Okay, closing net assets minus drawing plus capital. So basically if you see, all the 4 options are same. Closing net assets, drawings, capital introduced, opening net assets. The only thing is you have to know what to deduct and what to add. Okay, so the correct answer is closing net price plus drawings minus capital introduced minus opening net asset is the net profit. So only the drawings is added, rest all is deducted. Okay, the third statement. Next, which of the following explains the impress system of operating cash flow? Okay, so the correct answer is the exact amount of expenditure is reimbursed at intervals to maintain a fixed float. Third, which of the following statements are true about limited liability company? Okay, so now you can know, as I'm proceeding, what all comes for a financial accounting. You have to know about the types of companies, you have to know how it is formed and all. Okay, what is sole trader, what is partnership, what is limited liability companies, and also what if this is true. The company is exposed to debt and liabilities limited. Financial statements must be produced. A company continues to exist regardless of the identity of its owner. Okay, so in this case it is 2 and 3 only, not the first one. Now, and like I said, for management accounting, here also you have to do calculations. Okay, financial accounting also has calculation. And is a sole trader who does not keep full accounting records. The following details relate to our transactions with credit customers and supplier. Okay, which figure should appear in the statement of profit and loss for the purchasers? Okay, for this you have to know how to make the creditor control account. Okay, so you start with the trade payables, which is 60,000. Okay, opening trade payables, it starts. You don't have to take care of the receivables. Okay, even though the receivables are given in order for you, in order to confuse you. Okay, not everything what is given there you have to use it. You only have to use for purchases. So for purchases you only have to deal with trade payables and the cash which you have to pay to the supplier. You don't have to deal with customer or the trade receivables and anything like that. Okay, so 60,000 minus the cash paid to supplier. That means if you are making a debit credit or T account, the trade payable opening balance will come on the credit side. The cash which you have to pay to the supplier will come on the debit side. That's why it's minus 300 to 800. Minus discount received. You don't have to deal with discount paid or something. Discount received 2960, which again will be deducted. That means it will be on the debit side. Contra between payables and receivables. Whenever there's a contra, it will come in the payable also, it will come in the receivable also. Okay, again it will be on the debit side. That's why it's minus. And finally, whatever is there, that is the balancing figure, the closing figure. Okay, so in this case, it will be 331,760. Check it out for yourself. Okay. Next, which two of the following errors would cause the total of the debit column and the total of the credit column of trial balance not to agree? Okay, not to agree. A purchase of non-current asset was omitted from the accounting records. See, omission does not, the balance might be different, the total amount might be less or more, but both sides will be balanced. Okay, because when it's omitted means neither it is omitted on the debit side, neither it is omitted on the credit side. Totally it is omitted, so it will not make it differ. Okay, so first one is not correct. Second, a transposition error was made when entering a sales invoice into sales daybook. Okay, do you think it will? Nope. Why? Let's read the third and the fourth. A check received from a customer was credited to cash and correctly recognized in receivable. Check received from a customer was credited to cash and correctly recognized in receivable. It is credited to cash, but it has to be debit to cash, right? And when receivables included in the trial balance as a debit balance, again, it's wrong. Okay. Transposition error and omission will not make the balance to be different. Amount might be different. Okay. Next. So, at 31st December 2005, the following require inclusion in company's financial statements. Okay. So, the requirement is asking for each item what total figure should be included in the company's statement of financial position. Okay, basically what should be in the current assets and what should be in the current liabilities. Okay, so on 1st Jan 2005, the company made a loan to an employee receivable on a 1st Jan 2006. Repayable on 1st Jan 2006. Why are they saying? Because it is there in the current liability. Less than 12 months or 12 months. Charging interest of 2% per year on the due date. She repay the loan and pay the whole of the interest due on the loan to that date. Okay, it is something to do with current liability. The company paid an annual insurance premium of 9,000 covering the year ending 31st August 2006. And the third one, January 2006, the company received rent from a tenant of 4,000 covering the 6 months to 31st December 2005. Okay. When you are doing questions like this, you should know what comes in current assets, what comes in current liabilities, and then the amount. Then only you will be able to know. Sometimes current assets you might put in the current liability stuff you might put in the current assets. That should not be done. Okay. So here current liability is nil in this case. Why? Because I'm sorry, the first one is not liability. It would be liability if it is a loan taken from outside, but here the company made a loan to an employee. It's an employee loan. It's not a current liability. So current liability is nil. Nil means it's definitely either this or either this. Okay, second or the third. So that means we have to work on the current assets. So employee loan is how much? 12,000. Okay, now the loan interest on that 12,000 is the principal amount, so that will be there. With that you have to add the interest. What is the interest? 2%. 2% per year. That means 2% of 12,000. That is 240. Then comes second. The second one, if you see, it's a prepayment. Prepayment is a current asset. How much? What is the prepayment? It is 9,000. Okay, this prepayment for how many months they have paid in advance? For how many months? That you have to understand. For 8 months. Because they told cover the year ending 31st August 2006. So from 31st December 2005 to August, just calculate January, February, March, April, May, June, July, August. 8 months. So for 8 months they have prepaid on 31st December 2005. So 8 months. So 8 over 12 into 9,000, which will be 6,000. That also will be added because all these are current assets. Okay. And finally, the third one is also an asset. Accrued income. Okay. Accrued income is what? It's an asset. How much? 4,000. Okay. So the total will be 22,240. Next. A complete statement of, okay, so the question is what would be the net profit after adjusting for this error? Okay, after adjusting. A complete statement of profit or loss showed a net profit of 83,600. It was later found that 18,000 paid for the purchase of motor van had been debited to the motor expense account. So you can see 18,000 purchase for the motor van have been debited to the motor expense means expenses increase. Expenses increase means your net profit went down. So what do you have to do to correct it? You have to add back the 18,000. Okay, add back the 18,000 to 83,600 because it's an incorrectly they have put it as an expense, but it was not an expense. It was a non-current asset. Next, it is the company's policy to depreciate motor vans at 25% per year on a straight line basis with a full year's charge in the year of acquisition. That has to be deducted because they didn't take the depreciation. Okay, how many? 25% on the straight line basis. What was the motor van? Because definitely, how do you know that you have to add or deduct? the depreciation, because it is understood. Here it was a motor van, correct, which you purchased, but you incorrectly wrote as motor expense. That means even the depreciation relating to this motor van, you didn't take it. So that means if you didn't take it because of depreciation, now your net profit will reduce. That's why you have to deduct your depreciation now. So 25% on the straight line basis, motor van, that is 18,000. Okay, for 1 year. So 25% on 18,000 is 4,500. So 83,600 plus 18,000 minus 4,500, that depreciation, and it will be 97,100. Okay, next. Zena company has the following working capital ratios. Okay, 2009-8. So current ratio, receivable day, payable day, inventory turnover. Which of the following statements about Zena company is correct? Okay. So first observe the ratios. Just see what's happening. Look at current ratio from 2008 to 9. It's declining. It's not burst. It's okay, but it declined from 1.5 to 1.2. Receivable day 50 to 75 days. Now the customer is taking more time to pay, which is not good. Payable day, you are now paying faster, which is good for them, for your supplier, but on the other hand, cash flow problem will happen because now you have to pay more. And if you compare this, you have to pay in 30 days, but your customers are paying you back in 75 days, which is not a good thing. Inventory turnover is also increasing. Okay, so looking at this, which of this could be true? Zenith's liquidity working capital has improved in 2009. No. Is taking longer to pay supply in 2009. No. Zen is suffering from worsening liquidity position in 2009. Yes, but let's read the fourth one. Is receiving cash from customer more quickly? No. It is the third one. Next. Are the following statements true or false? Okay. So statement of cash flow prepared using direct method produce a different figure to net cash flow from operating activity produced by the indirect method. Is it true or false? Definitely it is false. Whether you use indirect or whether you use direct method for cash flow statement for the operating activities, the answer will be same. Right issue of shares do not feature in the statement of do not feature in a statement of cash flow. False. Why it's false? See, right issue will it has to do with cash. It will be there in the cash flow. Okay. If it was bonus issue, yes, because right issue increases your cost. You have to pay. Okay. Anything where cash is involved, it will be there in the cash flow. So in the right issue also cash is involved. A surplus on revaluation of non-current asset will not appear as an item in the statement of cash flow. It is true. Will not appear because a revaluation has nothing to do with cash, right? A profit on the sale of non-current asset will appear as an item under cash flow from investing activity in the statement of cash flow. Is it true or false? False. This shows that you have to be very good in your cash flow statement, okay? Statement of cash flow. You have to know what comes, what does not come. You have to know what comes in investing activities, what comes in operating activities, what comes in financial activities. You have to know how to make the operating profit figure using a direct and indirect method. Both you have to know. All these things you have to know. Okay, so this shows what all stuffs you need to know in financial accounting. Okay, next. A company receives rent from a large number of properties. The total rent received on 30th September. Date is very important, okay, when it comes to financial accounting. 30th April 2006 was this much. Following were the amounts of rent in advance and in arrears in 30th April, okay. So rent received in advance and arrears all subsequently received. Now, what amount of rental income will in the company's statement of profit or loss for the year ended 30th April 2006? Okay. So for this, what you have to do, you can quickly make a T account. Okay. So starting with this, what is it? Rent received in advance, 28,700. Okay, this will be a debit balance. Then you have to deduct this 21,200 arrears. Then add the rent received in a year. What is it? This one, 48,200. Then from there you deduct the received in advance. Okay, closing receive in advance you deduct, because it will come on the credit side, and then you have to add the arrears 18,400, and then finally basically you have to do a T account. Okay, let me repeat the steps again. First you deduct this, that difference you add with this, then you deduct advancement and add the arrears. Okay, that shall lead you to 475,900. Next, why add deduct? Because if you understand, when you go through your accruals and prepayments, there it is stored. Okay, why it is like this, then you will understand it better. Which two of the following are difference between a sole trader and limited liability company? Okay, you have to know the types of companies, how they're set up, how they are formed, what is the difference. So sole trader financial statements are private company financial statements are sent to shareholders and may be publicly listed. What is the difference? Next, only companies have capital invested into the business. Is it? No. Even sole trader has. Sole trader invests their own capital. Sole trader is fully and personally responsible for any losses that the business might make. Yes. It's not limited. It's unlimited. Devaluations can be carried on the financial statements of a company but not in the financial statements of a sole trader. No. So it's just the two. Okay. Next. Which of the following statement is true? Is true. Okay. So the word says is true. Otherwise the question would ask, if there were more than one, they would have asked which of the statements are true. Okay. Is means it's just one. So the analysis of the financial statements using ratio provides useful information when compared with previous. So that means ratio. When you're using ratio, it compares with previous or industry averages for that financial statement, which is true, but we'll read the other three also. Interpretation of entities' financial statements using ratios only useful for potential investors. No, it's useful for range of stakeholders. Ratios based on historical data can predict the future performance. No, you cannot predict based on history, because in history the events were something else. In future it might be different. Last, an entity's management will not assess an entity's performance using financial ratio. No, it is wrong. How can you not assess an entity performance? You can. So it is the first one. A company's motor vehicle at cost is this one. Okay. What opening balance would be included in the following PDS trial balance for motor vehicles at 1st of July 2006? Okay. Which one out of this? It is definitely this balance. Okay, carried forward. That is 6,750. But is it debit or credit? The question is that. It is debit. Come on, yaar. It is motor vehicle. Motor vehicle is asset, right? Non-current asset. Non-current asset is a debit balance. Whenever an opening balance, it will be a debit balance only. It cannot be a credit balance. Next. Which of the following items must be disclosed in the note of the financial statements for the intangible assets? For the intangible assets. Okay, you have to know what is intangible assets and all. The useful life of intangible assets capitalized in the financial statements. Yes. Impairment losses written off intangibles during the period. Yes. A description of the development projects that have been undertaken during the period. No. A list of all intangible assets projects developed in the period. No. Only this two. Impairment and the useful life. Which of the financial statements are correct? Okay. So capitalized development expenditure must be amortized over a period of non-exceeding 5 years. Nothing. No. Capitalized development costs are shown in the statement of financial position under the heading of non-current asset. Yes. Whenever there is a capitalized development cost, it is shown in the financial statement as non-current asset. So 2 is correct. If certain criteria are met, research expenditure must be recognized as an intangible asset. No, research expenditure is recognized as an expense. Okay, so it's only 2. You have to know the development expenditure and research expenditure. Okay, how they are categorized, recognized and all. Following transaction related to Russian company's electricity expense ledger account for the year ended. This one. What amount should be charged to the estimate of profit or loss for the electricity? Interesting. So for this also, T account. Starting with this prepayment. Prepayment is a debit balance. Okay, from here, cash paid. This also will be a debit balance. So you can add both this, and the accrual carried forward. This also will be a debit balance. Okay, the carried forward. So add all, and it will be 6,600. Next. At 30th June 2005, a company's allowance for receivable was, so basically this is talking about what figure should appear in the statement of profit or loss for this item. In the statement of profit or loss, company's allowance for receivable was this one. 30th June 2006, that means after a year, trade receivable total was this much. It was decided to write off irrecoverable debt totaling this one and to adjust allowance for receivable to be equivalent to 5% of the trade receivable. They are talking about provision for debts, provision for doubtful debts and all. Okay, how do you do this? So we know the irrecoverable debt written off. What is it? 37,000, right? Then, which is a debit balance. Then, what is a credit balance? Decrease in allowance for receivable. Okay, you have to find out. To find what is in the profit or loss account, you have to know how much it increased or decreased. That increase or decrease only will go. Okay, so a working has to be done for that. What is the working? Start with your trade receivable. Okay, so your trade receivable was this much. From there, deduct this debts of 37,000, which will be 480,000. Okay, then on that 480,000, 5%, which is allowance, take, which is 24,000, add, and allowance for receivable on 30th June is how much? Which is 39,000, right? So with and what? So you can see your allowance of 5% of 48,000 is 24,000 and this is 39,000. So it increased by how much? From 24 to 39. 50, sorry, decreased from 39 to 24,000. So 15,000, it's a decrease. 15,000 it decreased. Okay, because it decreased and your irrecoverable debt was 37,000, it decreased. So it will be minus 37 minus 15,000, which will be 22,000. I'm sure you are able to follow me. For those who does not have access to the answers and all, okay, who is seeing this video for the first time and who does not have access, make sure you write it down as I say. Okay, next, what is it? The total of the list of the balances in Valley Company's payable ledger was this much. This balance did not agree with the Valley's payable ledger control account. The following errors were discovered. What amount should Valley Company report in its statement of financial position as accounts payable at 30th June 2006? Okay. Contra entry 980 was recorded in payable ledger control account but not in payable ledger. Total of purchase return debit was under cost. Invoice of this one was posted to the supply account as this much. Okay, so there are many types of error principle. Okay, transposition error is there, right? Not recording on one side but recording in one account. So there are many types of errors are there, but after you correct, what will be there? Recorded in the accounts payable. Again, make a T account. Okay, start with this balance 438 900. From there you deduct the contra 980. Why a contingent, if this one was recorded in the payable ledger control account but not in the payable ledger? Okay, it needs to be deducted. Next, second one, it does not affect the list of balances. They are talking about the total of the purchase return day book, so it does not affect this one, payable ledger. So you do nothing, but you need to write, I'm sorry, not right, but you need to understand that it does not affect. Third, there's an error. You can see 4344 4434. Okay, so that 3 they have changed it with 4. Yes, it's transposition error. Rather than write 3 4, they are writing 4 3. So what do you have to do? There's a difference of 90, right? That needs to be deducted. Okay, so after it, what is the balance? 437830. Next, according to IS2, which of the two of the following costs should be included in value the invoice as a manufacturing company? General administrative overhead, no. Carriage in was yes. Depreciation of factory machinery, yes. Not carriage outwards, okay? According to IS2. This does not come. These are costs, but it does not come for the inventory. For inventory, carriage inwards definitely come. Depreciation of factory. See, depreciation usually does not come, but depreciation of factory machinery comes when you're valuing inventory because it is for the manufacturing company. What is Prisha's cost profit for the year? Okay, make sure you know how to calculate gross profit, net profit, all those things. Okay. So it starts with opening inventory plus purchase minus closing inventory. Okay, that is known as the cost of sales. On that, you take a percentage and find the gross profit. Okay, Prisha is a sole trader, not kept accurate accounting records during the financial year. She had opening inventory of 6,700 and purchase costing 84,000 during the year. The year end she had 5,400 left in inventory. All sales are made at a markup on a cost of 20%. All sales are made at a markup on a cost of. That's why you have to first find cost of sales to apply that 20% on, and that get the sales and then the gross profit. Okay. So start with opening inventory, which was 6,700. Then you add your purchases, which is 84,000. Then you deduct your closing inventory, which is 5,400. Cost of sales is 85,300. On that, take 20%, which is 17,060. That 17,060 is your gross profit. Next. Okay. What is it? At 31st December 2004, company's capital structure is follows. So capital structure is also think. Okay, you have to know your ordinary share capital, share premium, and all those things. Okay. In the year end 31st December 2005, the company made a right issue of 1 share for 2 held at $1 per share, and this was taken up in full. You have to know what is bonus issue and right issue. Later in the year, the company made a bonus issue of 1 share for every 5 held using the share premium account for the purpose. What is the capital structure? Okay. You have to draw T account. Okay. For that, you have to individually find what is the ordinary share capital and the share premium account. Let us first start with the ordinary share capital. So it starts with 125,000 and then they say the right issue. Right issue will be how much? Right issue will be, they told, made a right issue of 1 share for every 2 held. That means divide this by 2. So it will be 62,500. So add that 62,500 with 125,000. Then there's a bonus issue. Bonus issue will be how much? 1 share for every 5 share held later in the year. That means first you are making a right issue, then you are taking the bonus issue. So how are you taking bonus issue? Are you taking 125 divided by 5? No, you also have to add your right issue now. So 125 plus 62.5, 187.5, on that you have to take 5. That divide by 5. That will lead you to 37,500. So add all. It is leading to 225,000. So you can see here the first and the second one. Okay. Either your share premium could be 250, either it could be 325. This limits your answer. Okay. This shows that if you're not getting answer for the share premium, any of this two, that means something is wrong in your calculation. Okay. So let us see the share premium now. Share premium starts with 100,000. Now for the right issue. Okay. Right issue will be how much? At 1. Okay. If you see here, it is at 25 cents. At 1. So that means 75 cents. Okay. Share premium, the difference between the two, 75 cents. So it will be how much? How are you getting it? It will be 250,000 into 75 cents. How 250,000? How How 250,000? Because the total number of share is how much? Number of shares 500,000. Okay, so right issue means 500 divided by 250,000. So on that 250 multiply by 75 cents for share premium. That's why it's 187,500. Bonus issue it will not affect share premium. Okay, it will be same only because you are using. You have to deduct in fact that bonus issue, that 37,500 which you got for ordinary share capital, same amount you need to deduct from share premium because it says using the share premium account for this purpose. What purpose? For the bonus issue. You're issuing bonus using share premium account. Deduct that 37,500. You'll be left with 250,000. So the correct answer is the first one. Okay. Next. Which of the following should appear in a company's statement of changes in equity? Make sure that you know what are the things which are there in statement of changes in equity. Total comprehensive income for the year, amortization of capitalized development cost, or surplus on revaluation of non-current assets. So it is 1 and 3 only. Okay. Next. The plant and machinery account at cost of our business for year ended was follows. So you have been given plant and machinery, you have been given disposal also, as you can see. The company's policy is to charge depreciation 20% a year on a straight line basis with proportionate depreciation in the years of purchase and disposal. Proportionate means they are taking the number of months. Sometimes you are taking in between the year, so you cannot take the whole year when you are depreciating. Okay, what should the depreciation charge be for the year in 31st December 2005? Okay. So depreciation you have to take on this 240,000 before disposing. Okay, until the date of disposal. It was this. You're disposing it on 31st March. Remember that. So for the first 3 months, January, when is the balance? 1st of January to 31st March. January, February, March. First 3 months you are depreciating this 240,000. Okay, at what percentage? At 20%. Straight line basis. Okay, so 20% into 240 into 3 months will be 12,000. Next, you are disposing. How much? 60,000. Okay, you're disposing 60,000. That means from this 240, 60,000 you're disposing. How much you're left with? 180,000. That 180,000, again you are taking 20%. And how many months? 3 months. Why 3 months? 31st March to 30th June. Okay, April, May, June. 3 months. Because then you are acquiring a plant. Okay. So again 3 months, which will be 9,000. Keep on adding because all this in the depreciation account. Okay. Next, when you purchased this 160,000, on this 160,000, 20% now for 6 months. Okay, from 30th June to December. So it will be 34,000. Add all 12,000 plus 9,000 plus 34,000, which will be 55,000. Next. Okay. The following extracts are from Hassan Company's financial statements for the year end 31st December 2006. What is the return on capital employed? To know return on capital employed, you have to know the formula. What is the formula? The formula is profit before interest and tax divided by capital employed. So profit before interest and tax is what? This one, 10,200. Correct? But capital employed you are not given as it is. You have to find out. What is capital employed? Shareholders equity plus non-current liabilities. So okay. It is this. Simply 42,500 only. Okay, because shareholders equity means share capital plus other components of equity plus this loan, which is non-current liabilities only. So that means it will be 10,200 divided by 42,500, which will be 24%. Next, is each of the following statements about sales tax true or false? Okay, sales tax is an expense to the ultimate consumer on the goods purchased. True. Sales tax is recorded as an income in the accounts of the entity selling the goods. False. Next. Q company's trial balance failed to agree and suspense account was opened for the difference. Q company does not keep receivable and payable control accounts. Does not keep receivable and payable control of the following is found in there. Q is accounting accounts. Okay, you should know what is the suspense account. When do we create suspense account? When errors are made to correct the error. But ultimately the suspense account has to go out. once you start correcting the error. Okay, it is a temporary account which you are keeping. So first one, in recording an issue of shares at par, cash received was this much was credited to the ordinary share capital account. Okay, as 330,000. So the question is, are you using a suspense account or not? You have to think which account is debited, which account is credited. If this is a suspense account, definitely either suspense account will be debited or credited. If so, the suspense account, in that case, it is not debited, it is not credited, that means it is not required. Okay, suspense account will not be used. So there, the first one, what is it? It is credited as 330,000. It is credited less. How much? By 3,000. So less means you have to increase the share capital account by 3,000. How do you increase the share capital account? By crediting it by 3,000, the difference. So credit ordinary share capital 3,000, and where do you debit the shortfall? Suspense account. So that means suspense account is needed in first one. Okay. So I definitely know first one is there. It will be used to correct the account. Second one, cash of 2,800 paid for plant repairs was correctly accounted for in the cash book but was credited to the plant asset account. This one, okay, paid for the plant repair. So read it again. Not understanding first time, it's okay, read it again. Cash of 2,800 paid for the plant repair was correctly accounted for in the cash book but was credited to the plant asset account. That means if it is credited in the plant asset account, you need to take it out from the plant asset account. Why? It has nothing to do with plant asset. It was a plant repair. So you debit it back. It was credited, now you debit it, because credit and a debit cancels it off, becomes zero. So plant asset account you debit. How much? 2,800 only. And you debit in the correct account. You put it in the correct account. What is the correct account? Debit in the plant repair account. 2,800. So debit in the plant asset account. Plant repair account also debit 2,800, 2,800. Where will you credit it? Suspense account 5,600. You need to credit in the suspense account. So suspense account is used in this one also. Okay, and the third statement. Petty cash balance 500 have been omitted from a trial balance. Okay, suspense account is needed because you debit in the petty cash and credit in the suspense account 500. First one and the last one. A check of 78,400 paid for the purchase of a motor car was correctly accounted for in the bank but was debited to the motor vehicle account as this much. So the amount is also wrong. Okay, the amount is wrong. You need to correct it. How do you correct? What is the difference? 9,000. Okay, so you credit 9,000 in the motor vehicle account and you debit where? Suspense account. That means in all the four you need suspense account. Okay, why you are crediting it by 9,000? Crediting it because when you have debited in the motor vehicle account, just check the amount was higher than this, so you want to reduce this amount to this amount. So when you want to reduce the amount, when it is debited, you credit the amount. That means credit the balance, which is 9,000. Okay, next. Prior to the financial year end of 31st July 2009, Canon had received a claim of 100,000 from a supplier for providing poor quality goods which was damaged the supplier's plant equipment. Canon lawyers have stated there is a 20% chance that Canon will successfully defend the claim. Which of the following is the correct accounting treatment for the claim in the financial statements for the year end 31st June 2009? So 31st July 2009. Okay. You have to know what is this nature. Okay. Canon should provide for the expected cost of the claim of 100,000. Yes. Can should disclose a contingent liability. Can should provide expected cost 20,000. Can should neither provide for or not disclose a claim. This is the first one. Okay. Why is it the first one? It could be the other things also. They could disclose it as a contingent liability. What is contingent liability? Something which is there. A liability will be which will be arising in the future because of the past events. Not yet happened. Okay. You are expecting there's a probability that this might become. But here they are saying that they will provide for the cost of the claim 100,000. How are they saying? Because, my dear, they told they have a 20% chance of succeeding. That means what? 80% they are going to lose. Higher amount. There's a higher chance that they are going to lose the claim. That means it's an obligation that they have to pay. Okay. Next. Gareth Assets takes registered trader purchased a computer for use in his business. The invoice for the company show the following costs relating to the purchases. Okay, how much they would capitalize a non-current asset in relation to the purchase. Computer, additional memory, delivery, installation, maintenance, sales tax. At all. Okay, make sure you know what is sales tax and how much are you going to capitalize from here. You are taking the computer, you are taking the additional memory, you are taking the delivery, you are taking the installation, but maintenance you are not taking. Maintenance is 1 year. This you cannot capitalize. Okay, so you are taking except maintenance all the other, which will be 1015. Okay, because maintenance is an expense which will be there in the profit or loss that you cannot capitalize. Next, the following bank reconciliation statement has been prepared by trainee accountant. What should be the correct balance per the cash book? Okay, how do you do this? So what is the overdraft per bank statement? It is 3860. Then unpresented checks, you less. Okay, just okay, this will be added. Okay, because when you're putting the overdraft per bank statement, put it in terms of bracket. Okay, it's a minus figure. Then you are deducting the unpresented checks. That means it will further go up. Basically you are adding both. Okay, the unpresented check and this, because this is because it's a mistake they have made. Okay, accuracy the numerical mistakes they have made because it is made by trainee accountant. Okay, so you have to reconcile, you have to correct it, add both, and then you have to add your outstanding lodgements, which is 16. So this number will be different after you add this. Then you are adding, basically you are deducting. Okay, you are deducting when you are correcting it, outstanding lodgements. So it will be 3670 balance at bank. It's a balance at bank because it will be a positive figure. For that you have to do the calculation actually. The ISB's conceptual framework of financial reporting identifies fundamental qualitative characteristics that make financial statements faithful to represent what it purpose to represent. Which two of the following are characteristics that are required to ensure faithful representation? This you have to know. Okay, ISB's conceptual framework and all. So one is completeness, other one is neutrality. Okay. Next. The following control account has been prepared by trainee accountant. Whenever such statement is given to you that this has been prepared by trainee accountant, means they have made a mistake. Either the debit they have put as credit, right? So that you have to correct. You blindly cannot take what they have given. So what should be the closing balance be when all the errors made in preparing the receivable ledger control have been corrected? That means definitely they have made some error which you have to correct. Okay, what is that mistake? So opening balance, okay, that's okay. Credit sale is also okay. Next, the cash sales. Cash sales does not come at all. Okay, neither debit, neither credit. Then the contra. This contra will be taken on the credit side, okay? Then cash received from credit customer. This cash received from credit customer is correct. This interest received on overdue accounts, charge on overdue accounts 2,400. This comes on the debit side. Then irrecoverable debt is there, correct. Allowances also is not there. Allowance is not there. Okay. So then your closing balance will be 307,100. Some things are on the wrong side, some things should not be there. Next. Are the following material events that have occurred after the reporting date and before the financial statements are approved adjusting events? Okay. You have to know what are adjusting events and what are not adjusting events. Okay, let us read. A valuation of property providing evidence that impairment invalid the reporting. Yes. It provides evidence of impairment at the reporting date. So it's an adjusting event. Sale of inventory held at the reporting date for less than cost. Yes. Because it is at the reporting date. Discovery of fraud or error affecting the financial statements. If it affects the financial statements, yes. Insolvency of a customer with a debt owing at the reporting date is still outstanding. It was outstanding at the reporting date means it is adjusting event. Next. A company values its inventory of engines using FIFO. And the company had 700 engines in inventory, valued at 190 each during the year. This transaction they have given. What is the company's closing inventory? Basically, this is a valuation of stock using FIFO method. Okay, you have to know that. So starting with your the 700. Okay. So it will be what? How do you start? Just give me some time so that I can go through this. So you start how many you sell and with the opening inventory. Your opening inventory is 700. You are selling what? 400 and okay 700. You are selling 400 and 250. So 400 plus 250 is 650. So from 700, 650 selling. What is the closing inventory? It is 50. Okay. So closing inventory that 50, you will be starting at 190. Okay. So 15 to 190, and you're purchasing how much? 500. Okay, 500 will be at 220. Okay. Next, you are purchasing 300. This 300 will be at 230. So you add all the three and it will add up to 188,500. Next. M is a sole trader and has an assets and liabilities, and she has paid this much capital and paid herself wages 800 per month. 31st December she had assets and liabilities. What is MS profit? Okay. So starting with assets and liabilities. Okay. Capital, if you want to know, just asset minus liability. Okay. Deduct your liability from asset. That's it. So this minus this will be your liability in the beginning. With that capital, the 65,000 you have to add. With that drawings you have to minus. Paid herself wages is like a drawing. 800 per month means 800 into 12. And then at closing, you take this minus this. That will be your closing capital. So opening capital, add capital, introduce, minus drawing. And the difference between that and with the closing capital, the Balance same figure is known as profit, which is 32,400. Next. Okay. What is next? And this is the last question for section A. Bumply extracted the trial balance for the year ended and the total of the debit exceed the credit by 500. Which of the following could explain the imbalance? Okay. Sales of 300 were omitted from sales daybook. See, total of the debit exceed the credit. Okay, debit is more. So sale of 300 were omitted means your credit will not be there. It has nothing to do with debit. Okay, it will not affect. So first one is not the answer. Irrecoverable debt of 150 were credited to receivable. This is also not, because your debit side is more. They told it is credited to receivable. So they should increase your credit side, but they are saying debit side is more. Okay. Discount received on 150 was extracted the debit column of the trial balance. It was extracted to the 150 was extracted to the debit column. Okay, we'll keep as this. Okay, the right answer is the third one. The bank ledger account did not agree with the bank statement by debit of 300. Bank ledger account did not agree with the bank statement by a debit of 300. The right answer is the third one. How? Explanation is required because discount received is what? It is a credit balance, right? And it's an error in of omission. Sorry, error of commission. So because it has been written in the debit side. So when you want to clear, if you put it, forget about it. Let me start again. Discount received was extracted to the debit side. Okay, first of all, error of commission, then it's a on the wrong side. Two mistakes are there. Discount received, it was on the debit side. Okay, so when you want to correct this error, okay, if you are putting credit rather than debit, if you put credit 150, what happens? It was before it was debit 150, now it is credit 150, both cancels out 0, right? So that's why you have to double the amount. Okay, 300, so you credit 300. Okay, so what happens? Sorry, it is you double the amount, so the debit side will be more. Okay, because it was extracted to the debit balance of the trial balance, debit side 150. So now when you're making a suspense account, it will be in the suspense account 150. So suspense account, it will be debited 300 and discount received, you are crediting it 150. Next, so section B, your section B is like this. You'll be given a background, same for F1, F2, F3, the three papers, and then you will be having some task, and from here onwards this will be continued in part 2. So in part 1, what I've covered is section A, 35 questions, just all will be covered in part 2. So inshallah, hoping to see you in part 2, and till then don't forget to subscribe to my channel and take care.